material is this?
Who cares about material? This is the IssuesWatch podcast. Hello, and welcome to the IssuesWatch podcast. I'm Brad Muniz, your host for bi-weekly accounting and auditing episodes. I'm an assurance principal at Clifton Larson Allen. And back with me today is Frank Boudelet, an emeritus partner at Witham and my co-presenter for the Society Law and Ethics webinar. Welcome back, Frank.
Glad to be here, Brad, but what material is this?
This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. A quick disclaimer, the views and statements expressed herein are our own and not necessarily those of NJCPA, CLA, or Witham. Okay, I think it might be rayon.
Oh, rayon.
That was from Animal House.
Oh, okay.
Okay. All right, so today, speaking about material,
Yes,
we're going to open up with materiality.
very important topic.
Yes, particularly materiality as it relates to a review.
Okay.
Now, we've known for many years that in audits you had to have materiality calculated and shown.
Yes.
And for the longest time, for reviews, you didn't have to.
Right.
Now, I called the ICPA one time real quick, and
Okay.
I argued with them.
Right.
And I said, why don't you tell us to calculate it? And they said, no, we're not going to do that. And later on, they come out with it.
But I think it was implied that
Yep.
you calculated it, but you never documented it.
Exactly. It was absolutely implied, and he even said that. And he and I were yelling at each other, and we were cutting each other off. So, well, yeah, I mean, I won friends at the ICPA.
You have.
Yes. But to your comment, it was implied. And you've done a lot of peer reviews. I've done peer reviews, and people just gloss over things,
Right.
and they don't pick up on the fact of what's implied, must and should, and all that stuff. And so then they came out and said, okay, we need materiality documented.
Right.
Okay, and let's just talk about materiality. Accountants should determine materiality for the financial statement as a whole and apply this materiality in designing the procedures to evaluate the results. Okay,
Makes
that's
sense.
great. Comes right out AR-C 90. What is materiality, real quick? It's generally explained that misstatements, including omissions, are considered to be material if there's a substantial likelihood that individually or in the aggregate. I like that because I have $1 million adjustment this way and $1,001 adjustment this way. It's immaterial. It's $1.
But do you make the entry?
Well, it depends. You should have to consider it individually
Right.
and in the aggregate.
Correct.
Okay? Because your assets might be misstated $1 million, your liabilities misstated $1 million. Yeah. Net equity is only $1, but I like that. They would influence the judgment made by a reasonable user of the financial statements. Right. Okay? Judgment about materiality are made in the light of surrounding circumstances and affected by size or nature of the misstatement or a combination of both.
Correct.
And lastly, in both qualitative and quantitative considerations.
Because you have to understand why, if there's an error, what's the rationale for it? Why did it occur?
Exactly.
Not just the amount, but why is it occurring?
Exactly.
That's important.
And is it going to just continue to occur?
Correct.
And if this is occurring and it's recurring regularly, what else might be happening that you're not considering?
Agreed.
It might be
Very
something
important.
in another account that you didn't look at because it wasn't material, but you see consistent errors here.
Right.
There's a good chance. Materiality is a matter of professional judgment.
Yes.
That always scares me when we say that
I know.
because as soon as we say that, we have the Rons of the world, and
Yes.
it's professional judgment.
Well, it's all material.
Right.
It's all material.
All material. It is affected by the accountant's perception of financial information needs of users.
Right.
So it gets very, very, and I'm not going to go through because we're almost halfway done. It gets very almost unclear as to what materiality is. Now, most of the practice aids will give you a checklist where it will calculate the materiality for you. Nice and simple. A checklist, streamlined process. Here's my materiality calculation. But you do have to put professional judgment into it.
We have to understand the business, right? I mean, some of these bullets here, understand the business, what the purpose of the financial statements are, who's the user of the financial statements. But the one thing that, you have to understand why you're doing the review. What's the purpose? Who's the users? For instance, suppose that you have a debt covenant, And the debt covenant says the company must show a profit.
Okay.
And the company has a $25 profit at the end of the year.
Show the profit. We're good. Pass the covenant.
Pass the covenant. What's material in that circumstance? Is it $26? Is that material?
Well, normally people calculate material on one or two items. Normally, I say revenue or total assets.
Right.
Right. And total assets are revenues $10 million. Blah, 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 blah. My calculation shows my materiality, to consider is $20,000.
Right.
Well, $20,000. However, we have to show a profit, and to your comment, we have $25.
Something to think about as you're going through these, and when you're making those entries, where you have these proposed entries, got to consider that. What's the impact on debt covenants? So,
because it goes back to the financial information need of the users.
Right. Absolutely.
You need to understand those aspects. And you calculate materiality generally at the beginning, and then you have to revise it. The revisions are generally a change in circumstances that occur during the review. Right. Any new information or changes. One of the biggest things we see is people calculate materiality on preliminary numbers, and they have a lot of adjustments.
Right, and then they don't go back.
Nope.
And then all of a sudden, when you go back with those entries, suddenly materiality, if it needs to be a smaller number, you got a problem.
Right.
Because now you might have skipped over items that were material and not looked at them. And that's, this is for review. It's also critical in audits as well, very critical in audits. But in the review circumstance, because we're given limited assurance. So what else do we have except our understanding, our doing ratio analysis, and then saying, yeah, it's materially correct.
Right.
What's materiality?
And we can go on for much longer with materiality, but let's talk about PCAOB.
I love the PCAOB.
We have 3.5 minutes left, and you have a couple pages here that came out yesterday, pretty much, right?
Yes, the document was 496-page document that was issued. So the PCAOB adopted a new quality control standard with risk-based approach designed to drive continuous improvement in audit quality. So here, I think the PCAOB took a step from the AICPA. Normally, we say, hey, whatever happens to PCAOB trickles down. I think here, because the AICPA came out with their quality management standards, QMS, and that's effective in 25. And so I think the PCAOB probably was working on this at simultaneous, and the AICPA heard about it and then put it into play before the PCAOB, so they beat them to the punch. But it's the same basic issue. So the Chair Williams stated, and I quote, "When QC systems operate ineffectively, investors are put at risk. But when QC systems operate effectively, quality audits performed in accordance with applicable professional and legal requirements are likely to follow, leaving investors better protected." So what this standard is really about is that you need to understand what risks your firm has and the type of work that you're doing. What industries are you in? Are they risky industries? Do you have the resources to make sure that you are adhering to all the standards? So that's very critical in that's understanding your own practice and setting your system up to monitor that.
The thing I found interesting is they're calling it a quality control standard.
Right.
Whereas AICPA went with quality management standard because they said we don't control quality, we manage quality.
Right. I don't know.
Out of sync with the PCAOB.
A little bit, yes.
Okay.
I think so.
So what type of big items are they?
So the big items they have here, they require firms to have policies and procedures to address situations when they become aware of information after accepting a client. So you've accepted a client, you're going along, all of a sudden something comes up. They want you now, if you see something, to say something. Go back to your client acceptance committee and say, hey, a couple of these items popped up. Should we continue with this client or should we resign right now in the middle? I know, right? Imagine that. But again, if something comes up that you would not have ordinarily accepted the client and you're finding that out during the audit, you better step back and say, maybe we shouldn't have accepted this client, or maybe we should resign.
I agree with the concept, but this reminds me of the textbooks. Remember the textbooks in college? Everything resulted in disengage from the client.
Yes, absolutely. So for firms and networks, they want you to understand that they're putting out quality control materials. How do they put them out? Understand where they're coming from. So they want that to be done. And then they also want annual training for staff. right? They want annual training, but they want it in professional and legal requirements. I think you didn't you do one of these on NOCLAR?
NOCLAR.
That's all about NOCLAR right there.
NOCLAR
Understanding.
from a PCAOB roundtable.
Right, from a PCAOB roundtable. So again, you have to now take that into consideration. Training your staff, anyone working on the accounts. The same thing when they're looking at. They want to increase your objective in specifying that searching. Okay, so they want you to understand better what external parties are using the financial statements and make sure that they are understanding how you're putting these financials together. Because again, it's the third-party users of financials. The last thing I just want to mention, I know we're running out of time, is those with more than 100 issuers.
Yeah, I couldn't believe this one.
Yeah. You are required now to have an external oversight function, and that's called an EQCF. And that person or that team is responsible for evaluating the judgments that you made on your audit to ensure that you came to the right conclusion.
So it's very interesting.
Yes.
So we have the big four, and then you have the national team, the other national firms that are really going to be the only ones that are going to be able to oversee. But you also, so a firm is going to have an EQCF.
Right.
They're also going to have a peer review that also evaluates to determine what their quality control function is. And then you have the inspection. Now the peer review and the EQ, the PCAOB inspection is not part of your control process. Now, the EQCF, do they have to be independent, or are they now part of your quality control function?
I think they need to be independent.
That's what I would think.
Yep.
So find another independent, and you have to watch out because they have to be independent of engagements. If they look at engagements,
another layer of cost for the firm. Just not that cost should matter, but another layer.
And the one thing that we've seen a lot of, I'll close on this.
Yes.
There's been a lot of fines that have come out lately by the PCAOB, and a good amount of the fines are going against the EQRs, the engagement quality reviewers.
Absolutely.
Yeah. So if you work if you handle SEC registrants as clients, or even if you work at a public company, look what's out there that's affecting your auditors, and then you might know why the fees are going up, unfortunately.
Yes.
A few closing notes. Visit the NJCPA's Accounting and Auditing Knowledge Hub at njcpa.org/hub/accounting for articles, resources, and upcoming events. And of course, be sure to join the Society's Accounting and Auditing Standards Interest Group. Sign up for free at njcpa.org/groups. Frank, thanks for joining me again.
Glad to be here, Brad. I enjoy these.
And thank you for watching or listening.